Hello and welcome. My name's Chris Cann with Aspermont and miningnews.net, and we're at Mining News Select in Perth. With me, I have Sean Russo from Noah's Rule. Sean, thanks for joining us. You are a hedging expert. That's what you do. That's your bread and butter. Just really interested to understand what you're seeing in the market at the moment from the corporates in terms of hedging activity.
Sure. I mean, we're in a period of adjustment. I think there's what we think is rather a unique window has opened up that we've made our clients aware of in the last 3 or 4 months. We've had a very substantial increase in the price of gold, particularly in Australian dollar terms. All the sustaining costs are going up. Everyone knows about that. But even with industry's best efforts to try and chase the gold price higher in terms of all the sustaining costs, there is a very substantial margin. The margin is actually so substantial that you can buy put options. So you can buy the right, you can buy insurance policy, if you like, to give you the right to sell gold at some price below, but not the obligation to do that. So better than a forward sale. So no commitment, but you get a level of cover. So you can buy meaningful put option strikes for relatively modest amounts of money. What do I mean by meaningful? You can buy protection at $3,000 an ounce, which is $1,000 over the kind of industry all sustaining cost. And you can buy those for, depending on how far out you're going, you might be spending $40 or $50 an ounce. Now, the market moves that much in a week. So if you think that, the range from Monday to Thursday in a week might be $30 or $40, but you could take that money and buy this cover at $3,000 for the next 2 years, 3 years, the premiums get more expensive as you go out. That changes, that's a game changer for companies because you're maintaining all of the upside leverage, but you're removing that downside risk. And certainly if a bank puts in their model 2,200 as the price they assume that you can borrow against, the sort of the price they want to put in, if you can now put in your model $3,000 an ounce and say that's guaranteed by a put option, changes your ability to gear, your ability to leverage. It is I hate that expression game changer, but I used it. So we'll stick with it. And Alkane, one of our clients, has just done exactly that. They announced just prior to their last quarterly that they bought $3,000 put option for the next 3 years. Okay. So on all the production they hadn't previously committed to forward sales is now underwritten at no less than 3,000, but all the upside leverage. We think that's fantastic. Some of our other clients are looking at that. They're a bit slower to react, but they're also looking at collars where instead of, people are generally aware of collars where you've got a put option below, but you sell a call option above to pay for it. Banks like to call that, zero cost. We insist on them being called zero cash flow. Everything has a cost if you take it from a bank, but at the end of the day, zero cash flow, you can give up upside above a price to underwrite a minimum below. Normally those are 1 for 1, and normally the price you give up is closer to the forward price than the price that you cover. At the moment, we're seeing clients being able to look at doing 1 call option and buying 3 puts, or 1 and buying 2 puts. So you can have 100,000 ounces of underwritten protection at say 3,000 or 3,200, and you might have to commit 50,000 ounces at 3,800 or 3,700 in order to create a zero cash flow column. That's fantastic. So these are the things that we're seeing. Now, that's good for people who've got a clean slate. Right? So if you're coming to this with a clean slate, you haven't committed, that's what you've got. At the same time, I think probably the headline grabber in the last week would be, Capricorn have, spent a substantial amount of money to crystallise the losses on hedges that they previously did. And at the same time, recognising, as we pointed out to our clients, the put options are cheap, they've also bought put options. And that's a bit confusing, I think, for people. We've had a lot of inquiry about that. Because if you actually buy gold, which is what they did, they bought gold and they bought a put option, essentially really they've done is what a market would call a synthetic call. So they actually spent shareholders' money to buy the upside back on the gold price. So although it looks like they're doing what we're recommending our clients to do, in a way it's different. But what they're doing is recognising that previous price regime where they put in hedging, that's costing money. And at some point, if you no longer need it, because it's no longer there to support debt, their sort of debt levels went off some time ago, their hedging's quite high relative to their debt, looking to moderate that. So I think it's, I'd say it's a good idea, poorly executed maybe in terms of, we would have just advised our clients to accelerate deliveries into the hedging, recognise a lower price over a period of time. It seems they'd rather spend money to close out the hedges and then report a higher achieved sale price. But the net effect on cash is going to be the same over time. So it's just a different way of approaching it. But the benefit, at least for them, is that if the price does actually fall here, that they haven't crystallised a substantial loss, and they won't get that back. The puts will allow them to sell gold at some price in the future. So let's say the gold price goes back $1,000. you'd be pretty embarrassed if you closed out your hedging only to find it go back. The put options allow them that there's minimum consequences in a sense to what they're doing, but it still comes with a very high price tag in the nearby.
Okay, so it sounds like clearly there are different ways to hedge, and depending on where you are as a corporate, you're going to need a different strategy, depending on whether you're coming at it with a clean slate, whether you have a legacy hedge book, or and where you view the gold price. But from previous conversations, you would suggest that shouldn't come into it.
Yeah, we try very hard to be price agnostic. I mean, I say constantly these things. The most dangerous person is the person who thinks they know where the gold price is going. I mean, none of us have a clue. At various times in the cycle, there'll be people giving you all the reasons where it's going next, but they're not the ones that told you it was going to be where it is today. So why put any credence in what they say? I think that the thing, to be fair to all of the people that have legacy hedge books, at the time that they put forwards in place to support their businesses when they did it, and Capricorn is the most successful mining company on a share price performance basis over the last 10 years, right? So hedging clearly hasn't impeded their ability to succeed, and that's because the hedging allowed them to avoid dilution when they were a 20-cent share. I mean, that's the benefit of that hedging, is multiplied in the return to shareholders. The cost of the hedging is irrelevant relative to the early dilution it avoided. So that's a different issue. So not against hedging. I think the thing that's fantastic at the moment is someone coming at a clean slate wanting to develop a Carl Winder today actually doesn't need to do forward selling to get the debt. They could actually borrow more money and buy puts. And I think we're going to see some of that while this window stays open until the circumstances change. If prices stay here and put options stay cheap, I think we'll see projects get financed where they, instead of borrowing for every $50 million they borrow 55, spend $5 million buying put options, underwrite the downside, but maintain all the upside. That's a fantastic outcome. But people say, well, that sounds too good to be true. And so, well, it's not too good to be true. It's just rare. Because it happened in 2006-07, it happened in 2011-12, and it's happening again now. That's the last 3 times I can remember in the 20 years at Noah's Rule that we've actually had an opportunity where the meaningful put option strikes can be purchased for a relatively modest amount of money, allowing you to gear a project without having to commit gold at a fixed price. So it's a rare window, but it's open, and we're encouraging people to take advantage of it before the window closes.
Sean, you're a friend of Mining News Select. We had you in Sydney. You're back with us, and we appreciate you taking the time. What have you made of Mining News Select Perth?
Well, the buzz here is really interesting. I was pretty overwhelmed, actually, how many people are here. And I think the tech side of things, the Future of Mining, is it, that you're running as well? Just had a wander around through there. And it's interesting. I think a lot of people always say you need a war to really develop technology, in the sense of, major advances in aircraft and all kinds of engineering and radar and things in times of war when governments throw money at it. But I think you look at the kind of mining companies are throwing at money trying to solve the issues of mining. You see all the tech companies here trying to do that. It's an area of amazing innovation, and I think bringing all the people together in this conference is fantastic. So for someone like me who's normally got their head down just thinking about what our clients have to do to stay in business the next 3 months, next 3 years, it's really refreshing to see this sort of area, just the technology and advances being made to try and hold the cost base down on one thing, but also to find the next resource. So it's great. I find it very encouraging, actually, to be here and to see what's going on. The future for mining looks pretty bright to me.
And I've seen you in the audience for some of the content sessions and the panels and keynotes over the past couple of days. Any key takeaways that have jumped out at you that you'll be happy to store somewhere?
Absolutely. I have been incredibly frustrated by watching what is happening around the world, with governments starting to throw money at mining, the critical metals type thing, and all the rest of it. And some of the bodies in Australia are getting involved. And what we look at and go, like, that mine shouldn't be funded, but because it's above a certain latitude, it qualifies for government money, without making too fine a point. That just kind of seems nuts to me. Well, I just heard Kate from AMEC on a panel, and just talking about the idea that, maybe if the government actually allocated the money to having proper government departments that would be able to facilitate approvals and do that. So the government actually should invest more money in being good at doing what the government is supposed to do, and the gatekeeping they've allocated to themselves, and let market allocate capital. I think that would be far more efficient. So that's the one thing that I've been upset about what I saw the government doing, but I didn't really understand the other side of it. Now listening to industry players, yeah, people just need to kick the government up the arse and say, do invest that money, please, in providing us with the infrastructure that you're supposed to do. Because if you're throwing money at individual projects, let the market do that. The market is pretty good at doing that. The problem is people with good projects can't advance them because they can't get approvals in a timely fashion. So, and that's even a bigger issue now with interest rates going up as well. So that's my big takeaway. Yeah, I mean, government needs to go back to doing what they should do and do that better, not be the allocators of at the end of the day taxpayers' capital in what is one of the riskier. Mine development is one of the riskier areas of industry in Australia.
Sean, always a pleasure. Thanks for taking the time to talk to us.
Pleasure. Thanks for having me.